Hello viewers and welcome to Wire Talks. Laddering is a useful tool for fixed income investors. It involves investing across, let's say, corporate bonds, government or sovereign bonds, municipal or state government bonds, or it could also be high yield bonds in line with the risk appetite. Indeed, such a strategy is useful only if investors are looking to hold the bonds till maturity. Of course, like any investment, one can always sell these bonds if a need arises or an opportunity comes your way. But as always, each investment has its own risk. In this case, you end up investing into bonds for maybe longer tenor. Of course, the issuer risk, even for a government bond, that's there. The price risk that comes in, but as long as you're holding till maturity, the price risk is negated. Importantly, it ensures liquidity across different timelines. It helps plan cash flows as maturities come across different years. And you can align these cash flows to possible goals of yours, which could be, let's assume, kids' education, longer term, or buying a real estate property at some point of time, or even for marriage, for kids, or if you're young enough, for yourself as well. Laddering also reduces reinvestment risk. As we know, interest rates move in cycle. Imagine you had a bond portfolio and the entire portfolio matured during 2020-21 when the interest rates were sub 2%. Of course, alternatively, one could be lucky if all the bonds matured in the last 1.5 years. But that's the idea of laddering a portfolio, wherein you stagger investments and thus reducing the reinvestment risk of the bonds as they mature. And now that we are seeing inflation coming off across the US, Europe, India, Australia, the markets are pricing no more rate hikes. Of course, now they are pricing rates to be cut in the next few months. The rates market or the bonds market are much more smarter. They start discounting those rate cuts much earlier. For example, we are seeing the US 10-year Treasury is back just at the 4% mark. The US 2-year Treasury is back just around 4.25%. So clearly, markets rates have started coming down. So in case you do plan to build a bond portfolio, maybe this is a time to start looking at some of those allocations. And indeed, if you like the video, please press the like button, press the bell button, and subscribe to my channel for many more videos ahead.